Well, is the rapid retreat of global markets presaging the feared double-dip recession? I sought the views of one of the most noted bears, Morgan Stanley's Gerard Minack, and you might be surprised by his answers. Well, Gerard, the bond market has been barking US double-dip recession. What do you think?
Well, look, the bond market, as the cliche go, has forecast 12 of the last 7 recessions. So they're possibly more accurate than the average economist, but I think they might be a little premature this time. I simply can't see the warning signs of a recession on a 2 or 3 quarter time horizon, but I do agree with the bond market in the sense that I think this is going to be a relatively short and stunted macro cycle, and there's a real risk of a recession in, let's say, 18 months' time.
There's also a lot of talk about deflation, and in fact, the US inflation is very low. Do you think there's a chance of long-term deflation in the US?
Look, I think that's certainly the risk. We've got core inflation rate measures now down around 1%. Growth is likely to be sub-trend for some time. The risk of a recession would really threaten to push inflation to 0 or lower. Now, whether we'd actually see sustained deflation, as we've seen in Japan, is another matter, because the Fed, particularly Mr Bernanke, who is terrified of this outcome, I'm sure would respond and will get more money printing. So I think it's the risk of deflation that will invite a quite vigorous response from policymakers, probably in the second half of next year.
And you've been writing that whatever happens with the economy, profit expectations look too high for the next couple of years. Could you just take us through that?
Sure. Look, the point is, I don't think you needed to think there was a double dip coming to think that equity markets were, a couple of months ago, overpriced. The fact is the earnings forecasts relied on a V-shaped, vigorous rebound. In the US, consensus sell-side forecasts were expecting a 83% increase in EPS between 2009 and 2012. Now, to me, that was la-la land stuff, and those numbers were always going to prove to be too optimistic, even if we avoided a double dip. And I think that's been one of the big factors contributing to the weakness in equities that we've seen over the last 2 or 3 months, the realisation that these earnings forecasts were too optimistic.
But do you think the market's now adjusted sufficiently to a more realistic profit outlook?
I think we've done most of the job. We've come from, in US terms, around 1,200 on the S&P 500. We're now down around 1,000. I think by the time we get down to, say, let's say 950, another 7 or 8% below where we are now, that the likely earnings weakness, if all we see is a tepid expansion, will be in the price. So we won't have priced a double dip, but we'll have priced a lacklustre second half of 2010, which I think is the most likely outcome.
Right, and a double dip would be a second whammy on the market, wouldn't it?
Absolutely. Look, if a double dip, all bets are off. And look, I'm still a big picture bear. I don't think we're out of the woods by any stretch. I'm starting to think, however, there may be a tradable rally in the second half of the year before, in the first half of next year, markets justifiably start to worry about a recession in the second half of 2011, and then we make new lows, and it's really game on as people start to worry about a quite severe recession.
What do you think about Europe? I mean, obviously the sovereign debt problem still exists, but some of the data, the economic data coming out of Europe is quite encouraging, don't you think?
It is. Look, Europe is the classic curate's egg, good in parts, with the euro weak, with Asia still quite strong. There's a lot of European companies that are doing very well, thank you. They're selling high-margin stuff to cashed-up Asians. It's all a lot more profitable now that the euro's weaker. So the core of Europe still looks okay. It's really that rotten periphery where the sovereign stress is so intense that's the big bit of bad news. We are quite bearish on the end game for sovereign stress. We think that the bailouts that have been implemented probably will not work over the medium term, but for now, Europe is benefiting from euro weakness and strength elsewhere in the world.
Thanks for joining us, Gerard.
You're welcome, Alan.